Well, good morning or good afternoon to everyone, depending on what part of the country you're calling in from. My name is Ginger Bell, and I am here today helping to go through our information with our experts. And today we're going to be talking about why be a non-delegated correspondent lender, and specifically talking about how to establish a warehouse line. So let me introduce our panel. As I said, my name is Ginger Bell. I'm an education specialist with Go-To Training, and both Finance of America and FirstFunding are great clients of mine who I've had the opportunity to work with for many years. And with me today, I have Garrett Griffin. Garrett is the National Non-Delegated Correspondent Sales Manager and extremely passionate, great background as far as NDC, over 25 years of experience helping brokers transition into becoming NDCs. And Nate Clear, who is Senior Account Executive for FirstFunding, who also has a great amount of experience, although not as many years as Garrett, extremely passionate about helping originators transition and grow and build their business as a non-delegated correspondent lender. So thank you both for joining us today. We're excited about the information that you have to share with us. And I'm quickly going to go through our objectives today. And the webinar will last about 45 minutes. I'm recording it. I'm going to send you a copy of the recording, copy of the slide deck afterwards. And our objective today is to explain how a warehouse line works and define the process of establishing a warehouse line, identify the requirements that you need to be able to establish a warehouse line, and then things you need to know. So let's go ahead and get started. And Nate, I'm going to start with you and explain to our audience exactly how a warehouse line works.
Absolutely, and I appreciate the opportunity to be on the call with you both. So a warehouse line, let's start off kind of with the idea of what is it backed by, et cetera. Can it be used for all sorts of things, or is it exclusive to funding mortgages? Well, the simple answer is in the non-delegated channel, a warehouse line is secured actually by the asset, which is the collateral of that transaction, the note. So anytime a warehouse advance is being made, it's being made with an interest in the actual security instrument, which is the note of that transaction. So very different from a credit-based lending, whereas you're going to look at a full financial history of that company and have much stronger covenants. With the asset-based lending, we're able to give a much larger multiple for facility so that you're able to fund those loans with a rather limited financial net worth. So in credit terms, the loan is able to be funded and then needs to be purchased by that secondary market investor. And we're generally looking for those purchase turn times to be 10 days or less, but certainly no longer than 30 days, in which case we would ask for that loan to be purchased off that warehouse facility, or we're looking for other ways where we can perhaps refinance that loan off of the facility so that we can get that line freed up so that we can make that next advance. So it is a rotating line of credit. So as a loan is funded and then purchased, those funds become available to you. So in any transaction, the funds need to come from somewhere. When you're moving from a broker transaction to a correspondent transaction, you're actually acting as the lender. So as a non-delegated correspondent, you're the lender. And as the lender, you need to be able to advance those funds. Well, most independent mortgage originators certainly don't have, the $2 to $10 million that they would need each month in order to make those originations. Nor do the secondary market investors generally want to receive self-funded loans. So they look to a bona fide warehouse funding facility to provide those advances on the mortgage originator's behalf. And that's what FirstFunding does. We receive a request from the mortgage originator at the time of closing or the time of funding, depending on your state, wet or dry funding states. We fulfill that request to make that advance with an interest in that collateral. And when the loan has been sent to the investor and the investor purchases that loan, those funds would then book back to the warehouse bank to pay off the warehouse advance. And then the warehouse facility would actually send on your remaining proceeds, so the money that you would receive in compensation for the sale of that loan.
And that's a great general idea as far as how it works. Sometimes I think just understanding the entire process and the difference, because, for most individuals who are looking at getting started as a non-delegated, they may be a mortgage broker, or they may be coming from a net branch. And I know we're starting to see that a lot in the industry, where individuals have worked for net branches and have realized that the environment has changed. In fact, that's one of the things we're talking about in NAM National. NAM National is doing a panel discussion about that. And so understanding the process is a little bit different from that of being a mortgage broker or that of working for an actual lender. Not a big difference, but a little bit different. So Nate, I'm going to let you start out with this, and then Garrett, I'm going to have you hop in a little bit as far as the process. And before we do that, I do want to piggyback on one of the things that you said, Nate, and that was that you're having the time on the line. Typically, that loan is held is that time between the time the loan is funded and the time that it is purchased then by the investor. And so, Garrett, I know you have a very a good record as far as making sure that those purchase review times are short. And so what are you seeing right now from Finance of America for that?
So I looked at our purchases month to date through October, and we're averaging 3 business days on purchasing loans, 3 to 4 business maximum. Yeah.
That's fantastic.
That's
yeah. And that makes a huge difference, because that's the amount of time that you can reuse that line again, which is important when you're looking at managing your pipeline. So something that's really important too, 2 things when you're looking at an investor, to be able to know what their turn times are. And then as far as looking for a warehouse lender like FirstFunding, then someone who works very well with those investors as well. So the 2 of them very much go hand in hand together. And then the other thing as far as managing that line and the pipeline, and I know Nate will talk a little bit at the end about some of the advantages that FirstFunding offers, but one of the things that you stand out above and beyond any other warehouse facilities out there, and that's the technology that you provide to help manage that pipeline and to be able to know where they are, what's coming up, how long it's been on the line, and things like that. And that's part of what Fuel offers, right?
Absolutely. Yeah. I mean, we certainly want our customers to be able to turn that line as many times as possible, so that they're given all the capacity that they need. One of the interesting caveats that FirstFunding has is that we actually base the warehouse line not on a multiple of net worth. Instead, it's based off of originations, which allows them to become extremely leveraged in regards to their net worth compared to what their line can grow to be. But one of the biggest indicators for us to be able to continue to increase that facility is to be able to manage their pipeline, just like the customers and those mortgage originators are looking to do. So that a $2 million warehouse facility could actually yield $6 million in origination without having to increase that line. And what I mean by that is that, as we talked about before, if Finance of America is purchasing loans in 3 business days, that gives you, you could turn that line 3-4 times a month, kind of depending on when those lines or when those loans are actually being closed and funded. So with something like that, a $2 million facility could give you a total of, say, $8 million in total capacity for that month, just being able to turn it.
One of the things I want to jump in is one of the primary reasons that FirstFunding is such a phenomenal strategic partner is how Nate shared that they base the warehouse capacity based on originations. Most traditional warehouse lines base the warehouse line off a very strict multiple of net worth. So as an example, if a customer had a $100,000 net worth and it was a 20-to-1 line, 20-to-1 multiple, the maximum they could get is $2 million, right? Well, that's great, but what if the customer does $5 million a month in originations? And so the flexibility that FirstFunding offers around the capacity based on origination size is a very strategic consideration in choosing them as a partner.
Excellent. So let's look at the loan manufacturing process then.
Sure.
Everything's the same as far as application, right? Processing, everything's the same as far as processing. Some things could change, Garrett, as far as ordering docs, their initial disclosures, because they're responsible for that. But what are some of the options they have for that as well?
Well, in terms of the disclosures, right, because they control the loan estimate and the intent to proceed, and then as a non-delegated correspondent, of course, we will allow them to use the AMC of their choice. They have a lot more control and flexibility in that process in terms of timing. Non-delegated correspondents can typically, because they control that piece, they have the ability to get it into underwriting and into closing sometimes faster than a traditional mortgage broker will. And in terms of the closing and funding, there's multiple resources and options available for them, including if they have the expertise to prepare the documents themselves, to use a third-party provider, and soon Finance of America will be offering an option for that.
Right.
And I think that's a really important point too, is for anybody that's listening, to kind of look internally and see how you want to staff that. We have a lot of customers, depending upon, what their reason is for looking at the non-delegated. I've got some guys that are, 2 and 3 man shops, and that, maybe the profitability or control over pricing is important to them. But a lot of them, it's that control feature. So figuring out, okay, am I able to handle the upfront disclosures? Am I going to be able to order my own appraisal? And do I want to do those things? A lot of guys do want to have that control over there, because they know that, hey, if I get an application in on Thursday, or a borrower comes into the office, a realtor relationship, I can take that application, I can get the LE, go over it with them, get their intent to proceed, order that appraisal all in that same day. Whereas if I'm doing it on a broker channel, there's a chance that there's going to be a 24-hour to 48-hour, setup turn time for that LE that I issued to be approved, so that an appraisal can be ordered. And if we look at just, this weekend, yesterday being Columbus Day, being able to order that appraisal as of Thursday last week instead of potentially waiting until Tuesday morning for that to be done is a huge savings. I mean, we saved 5 days there. So identifying that you're able to do that, and then like Garrett said, there's multiple options as far as the preparation of closing documents, the creation of the initial and the final CD, all things that you can either outsource to fulfillment partners, or I know that FAM is approaching very closely to be able to handle those services for you internally. So certainly keeping that in mind when you're looking at making this transition into the non-del space, who's going to be handle that. And I know that Garrett's a tremendous resource for asking more questions, and I'd be more than happy to help you guys out as well.
Right. So the initial part, there's some leverage, obviously, advantages that happen there. Underwriting, pretty much the same as far as what's happening when they broker a loan. So let's take it to closing. So and talk about the difference there when it goes to closing and funding. And I know this, Nate, this is an area where FirstFunding shines. So we look at that whole process in terms of funding, and I really want to focus in on that, because that's the main part of what has to do with them and their entire warehouse line.
Absolutely. So a lot of folks think that once a clear to close has been issued, that is the true go no go situation as far as that loan's considered, a loan's being created. But in actuality, in the non-delegated or correspondent or in any process, a loan does not exist until that loan has been funded. So wire has been sent and funding authorization has been given. So there's a huge distinction to know, especially as it relates to who is the lender on that transaction. You as the lender are choosing whether or not to request that wire and to have those funds dispersed. One of the unique things that FirstFunding brings to the table is that at the time that our originators submit a wire request directly to FirstFunding, and actually goes through a 400-point data point review as well as a QC review of the supporting documentation. So we're doing that upfront review for our customers on every single file, so that if there's any inconsistencies, we're able to catch those, alert the originator so that we can either get an updated supporting document or make the necessary changes in that process. Additionally, after a wire's been sent, we also provide funding authorization. So this is more unique to a wet funding state. What I mean by that is that the closing and the funding is happening simultaneously, meaning that the wire's sent, the signing's occurring, and that signed executed package is coming back for review. And what our team does internally is we look to see that everything's signed, dated, notarized correctly, that no changes to that closing disclosure have been made, and that if, for instance, Finance of America had put any prior to funding conditions on there, that we do have something that's identifying those funding conditions so that we're able to say, yep, we've got everything that we need. We do see this loan as being in a purchasable state at the time that funding authorization is. So that last kiss being the most important piece, because once we send those funds out and we have, the settlement agent has dispersed those funds, then we're kind of stuck with it. We need to get it delivered to the investor, and we want to ensure that the investor isn't going to have any qualms in being able to purchase that fund. So a big piece there in the funding piece. And one thing that I did want to speak about prior to that was the underwriting piece. And maybe Garrett, you can answer a little bit more to this. Generally, what we see is that investors underwrite for two different things. And in the non-delegated channel, some investors only underwrite for one of them. And what I'm talking about is underwriting for compliance as well as to make a credit decision. Would you be able to explain a little bit further as to what Finance of America's practices are?
Well, specifically as to the non-delegated correspondent channel, we want to make every effort that there's no quote unquote funding conditions that can materially affect the credit decision on the loan. So any conditions, a clear to close in the non-delegated correspondent channel really means clear to purchase as long as the at-closing conditions have been met. From a compliance perspective, obviously when the loan comes in, we're reviewing initially to make sure that that everything is executed and the dates are properly, and then we're reviewing the majority of TRID compliance at loan purchase.
Excellent. Yeah, and I mean, and I like to bring that up because I know that that's not the case for all investors out there, and probably another good question for anybody listening to go ahead and jot down. If you're looking at moving with Finance of America, it's very important to understand that underwriting is going to include that, and that is something that can change from investor to investor. So it's excellent to have on FirstFunding's part to be working with an investor like Finance of America who's able to provide that level of review during the underwrite as opposed to looking at it at the time that the funding's already been issued and now we may be looking at those items.
Well, and review is so important too, Nate, and you talked about the over 400-point review that you do at FirstFunding prior to the NDC being able to order that wire. So having that ability to have that second set of eyes, that extra compliance component to be able to know that it's not just you out there on your own, that you do truly have a team between Finance of America and what they're looking at, between FirstFunding, what you're looking at, and then obviously what the actual NDC is doing as well, that it really is a whole team approach to be able to go through the process. So let's talk about kind of what the process is as far as actually establishing a warehouse line. So, one of the things, obviously, if they're getting started as an NDC, and we talked about this in our last webinars, the first thing you need to do is check with the NMLS and your state for licensing requirements. What do you usually see as far as licensing, Nate?
Sure. Generally, the Northeast has a little bit more strict as far as net worth requirements. All the way up to around 250,000. As we move further west, it's either $100,000 or less, or no special licensure. So one of the things that I think that NMLS does a really great job of is, you can just put in whichever state you're in, lending license requirements, and it'll pull up everything that's required. So for the state of California, you're able to operate with the same licensures that you have as a broker, also as a correspondent. So if anybody else is in any other states and you want to send over those Q&As, be more than happy to take a look or talk about it with you. but generally there's not a lot of difference in the state of Nevada, Colorado, Utah. So, a lot of those states, there really isn't any differential as far as that licensing requirement to become a lender.
Right. So, and oftentimes knowing where to start is so important. So finding out what the licensing requirements are. And the next thing is to get signed up with FirstFunding and to be able to establish that warehouse line, correct?
That's correct. So generally, what we're looking to do on the warehouse lending piece is make a credit decision on the applicant, which is the entity that is applying to that facility. And we approach it with the understanding that you may not have a lot of these other pieces put in place. But what we want to do is be able to, okay, let's at least review you for that funding facility, and then we can issue a conditional approval. So much like a traditional loan underwrite, you submit everything over to them and they're saying, yep, this looks like a good loan. Here's your loan approval. Here are the remaining conditions that we will need in order to issue your final approval, your clear to close. We operate in the same capacity. So we feel that, most of our customers want to get the ball rolling. We're better since there's a lot of chicken and the egg that goes on as far as the other components of approval. Generally your investor, Finance of America, is going to be looking for a warehouse lender approval. MERS may be looking for a warehouse line approval. A lot of those components kind of come after you've got your conditional approval from your warehouse line. So we certainly want to be able to start that process earlier on.
And so once that process is started, then the next step would be to go through the rest of the list, which is, as you said, the wholesale lender. They want to know that they have been approved for a warehouse facility. Applying for MERS, that's another requirement they'll have to do, going through the UCDP, applying for insurance. And I think this is an area too that they'll probably do through the application process with FirstFunding, right?
That's correct. So the insurance is a pretty standard requirement for both your investors as well as your warehouse facility. So what kind of insurance are you looking for? We look for a $300,000 mortgage bankers E&O policy as well as a $300,000 fidelity policy. So it's different from any of your surety bonds that you may need. We do see these combined sometimes, and they're called a mortgage banker's bond, which includes both the E&O and the fidelity coverage. And you're probably looking at anywhere from $1,400 to $2,000 a year for that coverage. So relatively inexpensive, probably less than your car insurance. But it's really great coverage to have, especially once you move into that mortgage lender's role, so that should anything very much out of the ordinary pop up, you do have that coverage in place. And as it says here on the screen, there's no need in paying for the insurance until you're going to need it. So until you have your approvals, both with your investor as well as FirstFunding.
And again, I think, Nate, just the fact that walking someone through that, and as you said, don't pay for it until you have to start, because it is a process. A lot of people wouldn't necessarily think of that, and the fact that you advise on that, I think, is crucial. So next steps, obviously, receiving that approval, getting started as far as trading, and then being able to go through the process of submitting their first loan for underwriting. Talk about some of the training process that you go through.
Sure. So on the FirstFunding end, and then I'll let you finish up here. On the FirstFunding end, we're going to start you after you've received your final approval. You'll hop on a webinar call with us, with our Director of Operations. And it's going to go over kind of the step-by-step process as to how that warehouse line works and the different facilities that we may utilize, or you may utilize, as a newly formed non-delegated correspondent. So what I mean by that is, okay, what happens at time of application? Who's responsible for those loan estimates? So kind of okay, from the loan estimates have been generated, we've submitted it, we've gotten the clear to close. Now what do we do? And we can bring you through that process flow, whether you're utilizing Finance of America to draw your docs, a fulfillment service provider to draw your docs, or if you're going to draw your own closing documents and closing disclosures internally. From there, you're going to submit that wire request to us. Then we fund your loan, where to send the collateral. So, once that closing has occurred, where does that note go? So that's all covered well in advance of the time of your final approval, way before that clear to close. Once we get closer to that first loan, especially if you're going to be coming through FirstFunding and having ordering your wire direct through us, we do have a live hands-on training with a live loan. We've tried to do it in, kind of prior to a live loan, and what we've noticed is that nobody really cares or is going to retain that information until it's their loan, until this one really counts. So we like to be on the call with you every step of the way as you're putting in that information, as you're going through the supporting documentation, so that you have a firm handle. And then from there, you have continued support through our FastPass staff. So that's a bit of the training on our end. Also more than happy to go over pricing scenarios and pricing out those loans, as well as Garrett and Garrett's staff. So Garrett, you want to talk more about the training on your end and those welcome calls?
Sure, absolutely. So let me start by saying there's sort of a catch-22 when you bring up BAM's requirements for non-delegated correspondent approval. Our requirements are that you have to have a warehouse facility. It's one of the requirements of at least $1 million, and the E&O and fidelity bond in place prior to us issuing the approval. So that's why I counsel people as we start visiting about going into the non-del role, is it's critical to select your warehouse partner up front, get that approval secured, right? I mean, really, once you've got a FirstFunding warehouse line, you're fairly assured that Finance of America is going to approve you. I mean, we have these very, you can see what our criteria are. We require a minimum $75,000 unaudited net worth. Well, it's interesting, of course, that meets FirstFunding's guidelines, right? And that we require E&O of 300,000, right? Same thing. So our requirements match what FirstFunding's are. In addition, of course, we want to see investor scorecards and proper licensing. In terms of training, every non-delegated correspondent, we do a new NDC orientation. And on that phone call, I generally have the head of our purchasing team, Kat Liang. I have the center manager, the sales manager, the AE, and the customer service rep. And we go into a thorough introduction of doing business with Finance of America as a non-delegated correspondent. Much like Nate says, I give an overview of our technology so the customer knows what resources and what's available to do business with us. But the reality is, until they have a live loan to run through, it's kind of a moot point. So it's really critical that we circle in with the sales manager and the account executive to get on site as quickly as possible to get that first loan into the system, get it into underwriting, get it approved, and then work with FirstFunding to get a warehouse advance and get that loan purchased as quickly and timely as possible.
Very good. And you went through that criteria for FAM as far as NDC criteria, and so very similar than Nate as far as FirstFunding criteria as well. And I think probably the only thing you haven't really talked about a little that gone into detail is the credit score, minimum credit score, and then what the net worth and positive net income looks like.
Sure. So I can kind of touch on this, and I know Garrett, I believe your slides after this. So we're looking for a $75,000 net worth. A lot of the questions we get around that: does it need to be in the company? How much needs to be liquid? Are there seasoning requirements? So let me identify some of those. So we are looking at the entity as the applicant. So your actual company is requesting that warehouse funding facility. So generally speaking, we are looking for that full $75,000 net worth to be in the company. We do not, so I repeat, we do not have any set liquidity requirements. So I'm not going to tell you that you got to have, 50% of that 75K needs to be liquid. Generally, what we're looking for is that there's enough cash in the company in order to meet all of your bills and to pay overhead expenses, et cetera. There also aren't any seasoning requirements. So we have seen companies or individuals that provide capital contributions to the business in order to increase net worth requirements, whether it be to meet warehouse line requirements or investor requirements or licensing requirements, et cetera. That's completely up to you as the business owner. And so we don't require that there be a certain amount of seasoning on there. The positive net income, some exceptions may apply. So FirstFunding does, in some scenarios, work with newly formed entities or de novo entities. So we know that there's guys that have been originating for some time as a net branch, and sometimes they want to, maybe return to operating as an independent mortgage originator. We certainly can work with those guys, and in those cases, obviously they may not have a positive net worth yet because of all of their upfront costs. So we do know that there's unique situations on that, but generally speaking, yes, we would like to see a positive net income, that the company is profitable. Third, the account executive referral. So like Ginger had mentioned, Garrett and I have worked for a long time together since I got started in the industry. So working with him as well as the account executives at Finance of America as a referral source certainly bodes very well to our credit committee as they're reviewing those applications for approval. We talked about the insurance requirements. If anybody has any insurance that they currently have that they want me to take a look at, see if it would meet the warehouse lending requirements, more than happy to do it. A quick reference there is to always go to the exclusions. Generally, in those broker policies, they will show the exclusion of warehouse lending or mortgage banking or mortgage lending. So look for those kind of key terms in their exclusion section of your policy. No outstanding litigation. Some exceptions may apply. It's kind of a case-by-case basis. So we can certainly take a look at that. If you have any questions, more than happy to answer those. And then a 630 plus mid score on all principles is what we're looking for as far as our general requirements for that warehouse facility.
Very good. Garrett, do you want to throw anything on top of that? As
an investor, right, you'll notice that our requirements closely match what FirstFunding's are. But that's why the most important point on there is the traditional warehouse facility. As an investor, we recognize that the warehouse partners are going to evaluate this business partner at a deeper level of scrutiny than we typically do as a mortgage banking entity, right? We basically look at what the unaudited net worth is and don't dive any deeper, where FirstFunding is going to do a little deeper analysis in terms of cash flow and liquidity. For the most part, if you have met the requirements for a FirstFunding warehouse line, you have met the requirements for Finance of America. That's why I say it's sort of a catch-22, right? They really need to find their warehouse partner and get that warehouse line with FirstFunding, and then come to Finance of America, and it'll be a smooth, timely approval process.
Very good. So we've gone through the requirements. Let's talk about some of the things that are important to know and really to understand, and starting with the concept as far as a haircut. And so you both do a great job explaining this. Nate, I'll let you kind of jump in on this first, and then Garrett, you can add in as well. But the process is pretty simple to understand once you understand where the numbers fit in, right, Nate?
Absolutely. So I know for a lot of us, it's been a long time since we sat in a math classroom, so I want to make it as simple as possible. Really, we need to first identify, warehouse advance rate and haircut. And what they are is an inverse relationship. So a warehouse advance rate is the maximum amount that the warehouse line is going to fund on a given transaction. And a haircut is that shortage amount. So a 99% warehouse advance rate would equal a 1% haircut, just like a 1% haircut can equal a 99% warehouse advance rate. So what are we calculating for that advance rate? 99% of what? 1% of what? We're talking or referring to the loan amount. So if we had a $200,000 loan amount and our warehouse advance rate is 99%, what does that mean that our warehouse advance is going to be? 99% of that 200,000 is 198,000. or 1% of that $200,000, so a haircut amount of that $200,000 loan amount is $2,000, so $2,000 haircut. And the reason why the advance rate and the haircut definitions are important to us, or important to the mortgage originator, is because it refers to how much is going to be sent to the closing in comparison to what is actually needed in order to close that loan. So, Ginger, I don't know if we want to go to that next slide, or if we want to stay here and wait for any questions.
No, I think it's good to go through it because you can jump right into it on where that $2,000, what that means, the 1%.
Absolutely. So what we utilize at FirstFunding is a process called net funding. So, we've already talked about that advance rate and the haircut, referring to, how much is the warehouse line going to cover for each one of these fundings, and what am I going to be responsible for? And a lot of questions that I get is, okay, so if my warehouse line is only going to advance 99%, does that mean that I've got 1% that I've got to fund on every single deal? A lot of our guys would have enormous cash flow issues if they had to put 1%. So what we do in an effort to alleviate that, as well as to eliminate you, the originator, from paying interest on your own money, what we do is follow a process called net funding. And what we do in net funding is we deduct anything that's being paid to you, the mortgage originator, on that closing disclosure from the loan amount to give us a total needed to close. So if you're following along online, we've got a terrific slide here that shows that on the closing disclosure, the fees that are being payable, we have $2,000 in origination fees. We have prepaid interest at $250. And then we have prepaid reserves at $1,250. So in total, you've got, $3,500 in fees that are being made payable to the mortgage originator. So we would deduct those. But then we also have a lender credit of $1,500. So if we're subtracting a negative, I know it's going back to math class, but it's going to actually increase that total amount. So instead of the $3,500 being deducted, we're going to take $1,500 from that $3,500, which gives us the $2,000. So the total amount that's netted from what's needed for closing is $2,000, which actually matches that haircut. Therefore, there's no shortage. So in other words, what we've done is we've charged enough, even with the lender credit, to cover or offset 1% of that loan amount. So if in any scenario, the aggregate between origination fees, prepaid interest, and escrows or impounds, if that equates to 1%, then you will not have a shortage. Therefore, you won't have to bring any funds to the close. And Garrett, you can back me up on this. I mean, I would say probably 90% of the time, you're not going to have any shortages or have to put any money into that transaction until we start getting into the higher lender credits or higher loan amounts.
Yeah, so I always like to make it easy. If interest, escrows, and fees are greater than 1%, if the total of all the interest, escrows, and fees are greater than 1%, the originator is not going to have to make a contribution to make that close. When we get into higher lender credits, as Nate's talked about, that's when typically we see those when the non-delegated correspondent is going to offer to pay all of the fees on a particular transaction in the terms of lender credit. And in that event, then they have to work with the warehouse facility. I believe, Nate, you guys have them establish an account for that. Is that correct?
We can set one up. So like I said, we've got 90% of our guys are going to charge origination, escrows, per diem interest up front. They may put a small lender credit, but generally they won't need to use it. So in that scenario, the lender doesn't have to set anything up. But we do have guys that do, no cost to the borrower loans, or they're doing refinances, or they're doing VA loans where they're crediting all of that back up front. We're paying that VA funding fee up front. So they're looking to take that all out on the back end. And so in those scenarios, we do set up what's called a mortgage originator remainder account, so that anytime there's a shortage, we just pull from that account. We fund that at the closing. So settlement agent receives one wire instead of one from your warehouse bank and then one from the originator. So that it's fully funded. And then at the time of purchase, one thing that we do that's unique is that since we do a full reconciliation, we can pull out those funds that were used from that MOR account, replenish the account, and then still send on the remaining proceeds. Whereas a lot of other facilities may just send you one big check and then you're constantly having to refund that MOR account. So yeah, we could definitely set that up so that it's one of those things that's a set it and forget it. It'll cycle on its own.
Very good. So this kind of gives another idea as far as how to look at that, and an example where there's no shortage and the going through the funds, having this, and again, you'll walk them through this, through the process, everything from the very beginning, uploading that first loan, handing that off to Garrett and his team, having them go through what they need to do to upload the loans, the process, disclosures, underwriting, and then once you get that clear to close, what they need to do as far as getting those final docs, ordering the wire, and making sure that all those fees match up for what they need to do for closing, and then from that point, so now we're at funding, the wires ordered, but they don't get paid until when?
Loan purchase.
Loan purchase.
Right.
So I like to explain it that nobody gets paid until we all get paid together. So,
right. I like that.
At the closing, once again, we're netting out all fees that are paid to the mortgage originator on that closing disclosure. Wherever you lock that loan with Finance of America, that's then given at the time that loan is purchased. So FirstFunding, none of their fees are going to show up on that closing disclosure. Your account executive isn't going to get paid until that loan's been purchased off your warehouse facility. And FirstFunding, your warehouse lender is not going to get paid until that loan's been purchased. Thus, you're not going to get paid until that loan gets purchased. So we're really all in it together. Finance of America has it in, their best interest to be able to buy those loans. Otherwise, they've spent a bunch of money on being able to underwrite it, clear to close it, et cetera, without having been able to purchase that loan. Account executive isn't going to get paid until that loan's been purchased, and I haven't been paid, you haven't been paid. So we're all working together in order to get that loan purchased as quickly as possible.
Very good. So if you all have any questions, please feel free to type those in there. I don't see any questions right now. You guys have done a great job as far as going through the information. So Nate, how can someone get started with FirstFunding?
Absolutely. You can shoot me an email, nclear@firstfundingusa.com. More than happy to send out an application to you. More than happy to hop on a call with you and answer any questions that we weren't able to go over today. Or you can visit our website, www.firstfundingusa.com. It's got a ton of information on there, not only for the non-delegated channel, but some of the unique features that FirstFunding has. Here's some of the items that we have that we provide that's unique to FirstFunding. So our fuel lending platform keeps copies of all your supporting documentation, closed loan packages, our web-based delivery of loan proceeds, FastPass, which is the ability for you to order your wire, web or mobile phone applications, our website, as well as our FirstFunding University, and training and life support. So whatever you guys need, we certainly want to be able to provide you with as much information as you want.
Really, that is fantastic. And the benefits of the non-delegated channel, both of you have talked about some of those throughout this session today. And really, it comes down to the ability to better compete in the marketplace, have more control, relationship with realtors, and obviously that flexibility and smoother closing. So I'm not seeing any questions. We're going to close it out. Garrett, I'm going to throw it over to you to talk about what you see as the top benefits, and then Nate, I'm going to throw it to you, and then we'll close it out. So I'll look for questions while you're doing that.
So real briefly, I think it's critically important to note that even though you're securing a warehouse facility with FirstFunding based on a net worth as low as $75,000, and we've outlined all these processes to ensure that a loan is purchased in a timely manner every single time, that mechanically, the way that the loan closes and the advantages that you get as a lender are the exact same as if you had a $5 million net worth with delegated underwriting. You're still going to get a loan underwritten. You're still going to get it clear to close. You're still going to order a wire from a funding source. It's still going to disperse, and you're still going to sell the loan. And thus, you enjoy the secondary marketing exemption in terms of not having to have a compensation plan with the lender, the ability to get paid service release premium over and above the upfront legislative fee caps. And the big deal is branding yourself as a mortgage banker, because you have control of that transaction. You're in control of the loan estimate. You're in control of the fees that are disclosed. You're in control of the appraisal, and you're in control of the timing and methodology of your CD and closing documents. You have significant advantages relatively to a pure mortgage broker in the marketplace. So basically, you have the ability to operate as in the same mechanical way as Wells Fargo retail does in terms of the way that you close and fund your loans. And we find that that helps you grow your business. It helps you recruit better loan officers. It helps you close more loans because you have additional flexibility with fees and what you're able to disclose borrowers. And you're able to get more referral sources because often those referral sources are more comfortable working with a quote unquote mortgage banker in many transactions. And I will pass it to Nate with that.
I appreciate it, Garrett. I mean, you hit on a ton of those high points there. I think that profitability is one that's certainly there, but to think that the money's going to fall out of the sky isn't the case. But being able to have, like you said, that flexibility on being compensated both on the front end of the transaction, so being able to charge your own fees up front, all the way up to that 3% cap, as well as receiving service release premium on the secondary market, which is not disclosed, is huge for being able to increase your profitability, which then gives you more wiggle room to go out there and attract those loan officers that are looking for those higher compensation agreements. It affords you the ability to go after and get those guys. So I think that's a big piece. The marketability of having that flexibility in pricing is huge, so that if the lender, you as the lender, the business owner, it's in your best interest to get the thin to win on a deal. You having that flexibility is huge. Being able to have your own name and brand yourself on your loan estimates, your closing disclosures, your closing documents. I think all of those things are really big in terms of showing to the borrower that you, in fact, are the lender on that transaction, that you do have you have control over when we're going to close, when we're going to be able to fund. So I certainly think that those are all big key pieces. Obviously, those are going to translate to your realtors and your settlement agents, your referral partners. They know that you as the lender, you having control over those aspects is huge for them being able to feel comfortable in giving referrals to you. So I saw one of the questions, I think it was just sent to the panelists, about typical dollar amount or number of loans per month it takes in order for becoming a non-delegated correspondent to make sense. And I know we touched on it earlier. I've got guys that are doing 3 and 4 loans a month that this makes sense for them. And why does it make sense for them? It's that control up front. They want to have complete control, or as much control as they feel comfortable with their borrower's experience. I've got some guys that want it from just simply, I need flexibility in the pricing, and the non-delegated channel affords me that opportunity. So is it a specific number? Is it a specific dollar amount in order for it to make sense? Maybe that's your approach. Maybe it's building a margin that makes sense so that you can continue to grow in that regard. So everybody's got kind of a unique situation, and it really depends on what you're looking to accomplish with that channel.
And you don't have to have a certain amount of loan originators too, because I know, Nate, you have many successful NDCs that are 1 and 2 person shops. So it depends, as you said, what the goals are and where you want to go with your business.
We're back to that variable outsourced solution, right? And using a third-party fulfillment provider and outsourcing your underwriting and not adding any full-time employees. And if you're able to do that model and pass that through directly to the borrower, then it can make sense at a smaller loan volume.
Right.
Absolutely.
So we have a question in that has to do with a captive warehouse line, and obviously that was a great discussion several years ago when the CFPB came out with their mini core guidance. And so, the question is First Funding my only warehouse line, and is FAM the only lender purchasing? So let's talk about, how the landscape is today. And I know that's a discussion we're going to get into on our BOBY tour that we have coming up. And then also at our session we're doing at NAM. But first of all, answer the question is First Funding my only warehouse line? Is FAM the only lender? What does that look like, guys?
So first off, let me say that it's not a captive warehouse line. A captive warehouse line, and I'll let Nate go into this in more detail, a captive warehouse line by definition means that it's only good for one investor. And that is what the CFPB took such a hard line look at when they issued their guidance of a few years ago. So if you're approved with First Funding, while we would love every loan to come to Finance of America, you're not bound to fund every loan with Finance of America. Nate?
Absolutely. Yeah. And I think that this, I think it warrants kind of going in and taking a deeper step into the guidance memo that the CFPB came out with, was that in fact there were a couple of warehouse facilities out there that were captive. You can only send loans to this particular investor. And they went as far as to also have the investor order the wire on the customer's behalf. So, when you start to look at what is a correspondent transaction and who is the lender making the decision to go, no go, if that lender investor is only receiving those loans, they're underwriting it, they're creating documents, they're creating HUDs at the time, and they're also ordering that wire and handling the funding of it, what really has changed other than the funding source or the source of funds for that transaction? Nothing. And so they deemed that to be a non-correspondent transaction, and we saw those retreat almost immediately, almost overnight. As well as we found a lot of guys that had opened up multiple facilities with the same warehouse line, but they were each captive. So they were once again getting to the amount of facilities they had, maybe $4 or $6 million in total between the 3 and 4 lines that they had. However, once you go back to no longer having a captive facility, it wasn't. They were only able to have $1 or $2 million in total capacity. So we saw a lot of bad things happen from it. First Funding never saw that as really a long-term goal. So from a warehouse funding standpoint, we've been in business since 2003, and anytime we look at these kind of flash in the pan ideas is, okay, are those guys going to be around, in 3 years from now? We're in it for the long haul, and so certainly take things like this question very seriously. And like Garrett alluded to, if you do get a warehouse line with First Funding and you just so happen to send all your business to Finance of America, neither of us are related. We certainly like doing business together, but there's really no problem with being able to do that, especially if you're only sending somebody once a month.
Right. And totally, as far as options on what you want to do with investors and with warehouse lenders. So I think that's important. So we're nearing the end of our hour. I'm not seeing any additional questions coming in. So Nate, you have given out your information there. I'm going to show it on the screen. I will be sending out the slide deck. So look for an email from me and I'll send that out to you as soon as we get done. And that will include both Nate's and Garrett's contact information. So you can contact them. If you do plan on attending NAM National, which is happening this week in Las Vegas, then please be sure to stop by the Finance of America booth, the First Funding booth, and attend our session on Sunday at 3 p.m. So I thank you both very much for your information, and I look forward to seeing you all soon.
Thanks, Ginger.
Thank you. Thanks.